Thanks a lot for having me, and thanks for everybody for attending today. First, a quick disclaimer. This is not investment advice, as usual, and you shouldn't rely on what I say anyway. Today we're going to talk about ETH derivatives and the market structure. We'll have a high-level overview of what's going on in CeFi and DeFi, the bridges between the two, and the goal is to give you an idea of why derivatives are important, how they're being built, and what are the key components that are required to build this ecosystem. So just to have an idea, who has traded derivatives previously? And who thinks they understand derivatives? I wouldn't claim I understand them. Very good. Okay, so let's get started. So first, let's start with a little story for those who are not very familiar with derivatives and to really clearly illustrate the purpose that they serve. So this is Bob. Bob attended CC last year. He was really excited, so all his friends did not get COVID. So he was quite happy, and he thought, okay, next year, I want to meet my friends again, and I want to invite them for dinner. I know there's going to be a bull run, so I'm going to make a lot of money. So I'm going to make a lot of money, so I want to spend some of that money to invite my friends for dinner. So he goes to Chef. Yes, there's going to be A, B, C, D, D for derivatives. So he goes to Chef, and Chef goes, yeah, sure, let me ask my farmer, because I'm going to need to cook for you. So Chef goes to Alice, and he asks, okay, I'm going to need to cook for Bob. How much is that going to cost me? And Alice says, well, right now, for my thing I'm harvesting, it's about 1 ETH. Great. So he goes back to Bob and says, well, I can do the catering. That will cost you 2 ETH. So Bob says, great. Sends the 2 ETH to Chef. And one pandemic later, we're here. Has anyone been invited by Bob? So Bob goes, is waiting for his guest to come, and Chef goes to Alice again and says, hey, could I have the food? And Alice goes, well, it's been tough this year. The heat, everything, it's going to cost you actually 2 ETH. So Chef goes, gives the 2 ETH, gets the food, and doesn't have anything left for him, right? So he's signed a contract with Bob, so he has to deliver on this. But still, now the price of the food he was supposed to get has increased, so he doesn't have anything left to eat and to feed his family, his kids. Bob is sad. So now, what if we introduce derivatives? What could Chef do to try and mitigate that risk and make sure he doesn't get eaten at the end of the day? So this is what Chef is going to do. Chef is going to get into a futures contract that will allow him to have some predictability of his cost far into the future. So same. So Bob goes and says, how much do you quote me? Chef goes and starts and gets into a futures contract and says, gives the same quote, 2 ETH, but now he has some predictability. So 1 year later, Chef goes back to Alice and says, hey, I need my food. Alice again comes and says, well, the prices have increased. It's going to be 2 ETH. So Chef pays the 2 ETH. But Chef had gone into this futures contract. So there was somebody, a trader, there was somebody in front of him who wanted to trade with him, wanted to potentially speculate, or knew what had some views on what the prices of the food would be. And so somebody lost money and now is paying Chef the difference. So now it's very nice because Alice made her money, Chef made his money, and everybody is invited to Bob's party. So what, for a little bit more context, I work at Kaiko, and what we do is we provide data on all these types of derivatives. We focus on market data, so very high level what we do is we connect to all the centralized, now also decentralized marketplaces, and we're going to go collect all the prices, we store them, we normalize them, standardize them across marketplaces, and then redistribute them. One interesting thing is we get data on-chain, that we bring to our platform, and we also get data from our platform that we post and publish on-chain, on Oracle systems. And as we'll see, oracles, if you want to have derivatives on-chain, are a key part of the ecosystem. So in terms of simple derivatives, we'll get a little bit more into this. So what Bob did, what Chev did was get a futures contract with a maturity, which is next year for the next ETH. And as you can see, there is here a little index price, which is the price at which he was going to pay for the food. And there's a couple more fields that we won't get into for now. Then there is something very interesting called a Perpetual Futures. It's typically easier to buy a contract on something than buying the something itself. And this is exactly what Goldman Sachs does when they offer you to buy crypto or get exposure to the asset class. And what's really nice with the Perpetual Futures is it doesn't really have an expiry. So it's rolling perpetually. So you don't have to go in and out of positions and roll it. So basically what you would have to do before would be, okay, have this futures for next year, and then getting closer to the maturity date, you need to roll your futures into a different future. So this is what solves Perpetual Futures. And then once you have a very liquid market on futures, you can build on top of it options. And options give you the option to buy at a later date, which is something Chef could have done as well. Right? And the beauty of all this is when you use options, you can actually, if you have infinite strikes, and you can actually discretize any type of payoff using options. And as I said, why Oracle is so important is because every time there is this index price, because derivatives derive from an underlying asset. And so you always need to have some reference price of that asset to price your derivative. Okay, so more on derivatives. So what do you do with those derivatives? So we've seen Bob, he used it to hedge some risk because Bob's job is to cook and to cater for people. His job is not to think about what the prices of the food is going to be in a year from now. There are other things that you can do. You can also, if you're doing some goal-based investing, you can sell some upside. Let's say I want to buy a house in the future. Maybe I don't care about getting infinitely rich. What I want is maximize the probability for me to be able to buy the house. So what I could do is get into some option contract to sell the upside. Let's say I don't care if Bitcoin goes past or Ethereum goes past $100,000. So I'm going to sell all the upside, and if the prices go up more than $100,000, sure, I'm not going to earn anything more. The difference is, well, somebody paid me for that upside. So today I have more money. And so I have more money to invest. And so even if I have a lower return on my money, I've increased the probability that eventually I'll be able to buy the house I wanted to buy. And there are a lot of other things, right? One of which being getting access to leverage. Why is leverage really useful sometimes is because if you can have some very low risk strategy that has very low returns. And so if you want to amplify those returns, obviously increasing the risk as well, to scale your strategy, you need to be able to take on leverage. And this is what hedge funds do, what they've always done, and what they'll keep doing. Why futures are also important is because they're easier to trade, they have higher liquidity, usually they have much lower transaction fees. So getting in and out of your positions is cheaper. And this is because of this as well, this goes into price discovery. And as was said in the previous talk today, a lot of the price discovery in traditional markets happens in the futures market, not on the spot markets. And it allows for very fine tuning of risk. You allow for reshuffling of the risk across market participants. And basically what you do is some sort of matchmaking for risk. It's people who know, have more information or think they have more information can take on one risk or another, and that allows for market participants to really focus on what they know and what their added value is to the system. A good example of that is, we had the food example, but a miner. What type of risk is what is bringing the miner. It's bringing hardware, it's bringing computation power to the system. So should they really be bearing a lot of price risk, hash rate risk, and all other types of risk? Speaking of liquidity and how prices form, because you always need that reference price that your derivatives contract is based on, that's been a really big question, even in centralized finance and in crypto finance, as people have tried to build ETFs and traded products. You need to understand how price discovery goes and what is the right price. If somebody comes to me, what price should I give them? And there have been issues with fake volumes, and that's this study that was presented to the SEC was made by Bitwise and clearly showed that some volume was really fake. Did not, by fake I mean it doesn't represent economic trades. And in terms of the role of derivatives in price discovery, this is, okay, what is leading the changes in prices? Is it on the spot market, on what exchanges, and does it come from the derivatives market, and what role does it play? And so why is this important to understand this? Because this really tells you how prices form, and this is key in having a stable derivatives market as well. And right now on the DeFi side is much younger, right? As we can see here, the total value logged right now is about a couple billion. Don't have the trading volumes, but it's still very early on because you need all that futures market to be really mature and to build options on top of it. And there's a lot more complexity in trading derivatives than in trading spot markets. So recently, if you looked at the top projects, here they are in derivatives. We won't go into all of those. I think there was quite a lot of mentions of Ribbon and Open. UMA is doing also great things and have a very interesting approach with their priceless oracle. So basically what they're doing is they have some form of consensus around what the price should be, and that only gets triggered from cryptonomics. So basically, you have incentives to not cheat, and hopefully, if you don't provide the right price, you'd be paying more than what you'd gain.
I think the question about Nexus Mutual.
Mm-hmm.
In my understanding, if you play with the derivative, it does have some impact on the real market because your counterparty will hedge and all that stuff.
Mm-hmm.
I don't see that with Nexus Mutual.
Well, you don't see the impact on the market?
I don't see an impact. So if you take a position in Nexus Mutual,
Mm-hmm.
which is an insurance product, I don't see the impact on the real market.
Well, every time, so what the question is, so Nexus Mutual, the way it works is like a mutual, is the mutualize the risks. So people can come into a pool and the risk is shared, and that allows them to provide insurance, right? At some point, if you start having something of really large sizes, you will impact the market, wouldn't you? And because some of those participants, whether if there starts to be a really big discrepancy with the rest of the market, people would be exiting their positions, or that would have some impact. So not being sure exactly, or maybe there's something more about the mechanics of how that works. But my impression would be that if you have really large volumes and you start having something that are really important, you'd have at some point all systems start getting back to reality, right? So you'd have people trying to hedge, you'd try people trying to buy the underlying, and you'd have squeezes. You'd have interactions with reality outside of Nexus Mutual. So CeFi and DeFi. So a lot has been done on the CeFi side, right? And there are big Wall Street names or financial names like the CME that have been trading for a long time options on Bitcoin. They've recently introduced futures on Ethereum. And why futures only? I don't think they have options yet. Because as we said, the first thing you need to do is build that liquidity on the futures that is then used to build the options contract. So right now, it's still at the futures stage, just to show you how early of a market this is. And then when you build your options, well, when you have an asset that whose prices doesn't vary much in time, it's easy. You can set up strikes, and these are not necessarily going to vary much in time. Well, when you have an asset that varies a lot in time, you need to make sure that you adjust those strikes, you have different maturities, etc. And this is where there are very interesting propositions that are being made in the DeFi space. Is what if you could outsource and have a decentralized options marketplace, like Open, for example, and then you can have insurance. But after all, insurance is just an option, right? You can buy insurance by writing an option. So if you look on Open, and this is where you also see how people are trying to reinvent the user experience in those options marketplaces. Another good example was eToro, which I think was really interesting. They even have literature on what you're buying and try to give you an idea. And you have this little slide range where they show you the payoff that you get depending on the price of the underlying, so you can play around with this, try to wrap your mind around it, trying to democratize and make people understand what is behind this. So as we mentioned, you need to have a vibrant futures market, and that's all about liquidity, because what you're doing, when Chef went to his futures trader for the trader to buy the risk, he needed to have a seller in front to buy to get the risk. So you need to have this liquidity. You need to have this matching that goes on between bidders and buyers, and sellers, who will buy or exchange that risk. So what's typically done, and if you go back to the history, at the beginning there were market designated market makers that were the only ones who could market make. Then that started with double-sided order books that got open, and anyone could do market making. And so this is what goes on in most of the centralized exchanges. Also on decentralized exchanges, some of the decentralized exchanges is you have bidders, you have bids and asks, people willing to buy, people willing to sell at different prices with different quantities. And when there is a match between the two, transaction forms and a trade is placed. And this is how markets work. And you can see here the bid, the best ask, the different strikes on Deribit for their option markets. You can see that if you look around the price at which the underlying is, you'll have more liquidity. If you go further away, sometimes you don't even have any data because there hasn't been trades. And so this is what the options market for Ethereum looks like for the August strike, the August maturity. And if you try and think based on different types, if you look at spot markets, if you look at futures, if you look at options, and you want to gauge the liquidity in those markets, what you can look at is the spread. The spread is basically the difference between the best bid and the best ask, so the prices at which people are willing to buy and sell. And this is what you would get. Futures are very liquid, with the most liquid being the Perpetual Futures on Bitcoin and Ethereum. Then you have spot markets in the middle and options, which are less liquid because there is less trading activity. And now if you had an entire layer on how those things interact between CeFi, DeFi, all the custody aspects, you get a lot of risks that are being taken into the system. You have smart contract risks, you have custody risks. And so being able to split those risks, split and slice, and help everyone interacting with the entire ecosystem is important and is exciting. And one final note on this is it's all about user experience. In my mind, what Uniswap did beautifully, and you can see in the screenshot, is people just at the end of the day just wanted to exchange assets. And they just made it easy. So we see this also for options and help people market make. So just to summarize, the key ingredients that you need for having a vibrant derivatives is liquidity. You need to have this futures liquidity to build on top of it, and building derivatives system is not easy. It takes time. It takes also understanding of the risk that you're taking, making sure you have all the liquidation systems in place. If you want how much collateral should be posted, prices vary a lot. Also, what's interesting in crypto is the quote asset is not always defined, right? I mean, is always changing. So when you look at all the synthetics and the synthetics protocols, they have very often they have to build a stable coin. Why? Because when you go and buy a stock of Tesla, it's a stock of Tesla, but actually implicitly is denominated in US dollars. So in effect, you're sort of having pairs, but that are simplified because they're always denominated in the currency you're used to using. In crypto, that's different, because very often you can have things denominated in Ethereum and BTC and other stable coins, and so you need to build all the interaction between those. And the key component of this is having prices you can rely on. And building trusted oracles in a decentralized setting is challenging, as we've seen. But even in the centralized markets, having proper valuation tools, having price feeds that are reliable, making sure that you can audit and see how the prices are calculated, what is the composition, what exchanges are you including in the mix, are you taking a VWAP, are you taking excluding outliers? There are many questions there as well. And so there are a few puns that are intended on the right. On the right. Just to summarize, a lot of this has been driven for optimizing yield, optimizing trading strategy, optimizing the way you manage risk. We're still early. There is a lot to be built, not only on the trading side, on the options market making side, but also even on the protocol side, and making sure we have good smart contracts, and a lot of innovation hopefully will follow. It's all based on liquidity because you need very liquid underlyings. And what's fascinating is if things become so interoperable and you start getting IoT data on chain, and what will we be able to hedge as risk? Can we go even beyond what's possible today? And finally, one big thing is, all these, they rely on network effects. So what that means is you have distributions with fat tails. What you expect is very large returns on a few of your investments. So what that means is things are not normal. And I don't know if some of you know about the Black-Scholes-Merton model. So be careful about the mathematical assumptions when you price those derivatives, especially options, because if there is a rare event, you might get eaten. And this is the purpose of those few memes, which is remember about fat tail. If you have a long tail risk, you need to get that into account in your price. And in this case, so when you look at rare events, it goes from rare to getting ruined, and in this case, the ruined is the one that gets eaten. And so two very serious quotes taken from CNBC, so a very reliable source. Yes, please remember to put on your swimsuit. And now we'll open for questions. No questions.